Thank you all for joining us again this month. I appreciate those who adjusted. We moved it a week from our normal time of month because we were still doing breakfast seminars right up until actually yesterday morning was our last one. So thank you all for picking up on the later date in the month. Got Darren along with me today from our Brisbane office, so it's very exciting to have another face joining the crew. So before we get stuck into the day's topic, again, as normal, I like to do a little bit of an update on what's going on in the last month. And to be honest, it's probably like the insolvency world's going back to what it always was, and that is that not much happens differently from month to month. There's not a lot of new legislation or anything like that going on. But a couple of stats for those, some of you who may have been at the breakfast will have heard some of these, but if you weren't able to make it to the in-person or prefer us online, some of the stat data that came out, which was really interesting. One of the big ones is we're hearing in the press a lot at the moment about insolvency rates going through the roof and all the doom and gloom that papers like to actually say. But when you look at the actual numbers rather than the carry-on that can occur, to give you an example, wind-up applications in the first 7 months of this year, being January through to August, was 457 wind-up applications were raised. In the same period in 2019-20, going back before the whole pandemic world, in that same period, there was actually 950 wind-up applications. So although we're seeing a lot of increased activity and there is a lot of stress starting to hit the marketplace, we're still a long way from what would be considered normal for us, or for any part of the Australian economy. So I still believe that we're on that rise and we're on that sort of coming up the path towards a fair bit of pain, but we're still a long way from that. And if we look at it from a personal insolvency point of view, there's probably only 50% of the personal insolvencies have occurred if you look at that pre-pandemic to the current pandemic mode. What is a little bit unusual is the high amount of activity that we're seeing from the ATO, but not in wind-up applications and bankruptcy notices. There's a significant increase in the ATO chasing through what is called money owed processes, so going after statement of claims and chasing people, but they haven't got to bankruptcy notices and they haven't got the wind-up applications yet. So that groundswell is really coming. And I can't put the graph up today, but there's probably 4 times the amount of claims being made in this sector compared to actually bankruptcy notices or wind-up applications. So again, that groundswell is coming. So just a couple of things to keep in mind. If you want to know more about the stats, I'm more than happy to talk about that a little bit more. Just give us a call a little bit later. But we'll get stuck into things, Darren. So as I said, we've got Darren joining us today, who's from our Brisbane office, and we're going to run through some of the information that we actually had in our breakfast seminar. But and some of the key things that you need to think about when you're talking to clients about which way to deal with insolvency, what things are important and what things aren't. But before we get into that, Darren is actually one of our longest running strategists. He's been putting up with me now for nearly 10 years, mate.
Yes, more than 10 years.
We've certainly had some fun and we've certainly had some interesting cases over the journey. But why don't, for those who don't know you, why don't we give you a chance now to sort of talk a little bit about where you came from and what's going on in your world.
All right, thanks, Ashley. Yeah, well, I've been with the firm for about 11 years now. I'm an ex-NAB senior business banking manager. I worked at the NAB for about 21 years. And I did various roles in the NAB, from being a line manager, a credit manager, and as part of my last role, I managed the BNZA impaired assets that come across the NAB when NAB merged back with BNZA. So I have a bit of a collections and impaired asset history from that.
Right. So between 20 odd years with the bank and then 10 to 11 years with us, it's That's the world of Darren, the banker and the insolvency man. All right. So today, as I mentioned, we're going to have a run through some of the information from our latest seminar. And I guess the key thing here is that we want to highlight some of the positives and the negatives of the various forms of insolvency.
Yeah, well, that's right, Ashley. Look, as you know, when we first meet a client, we need to get a detailed breakdown of what's going on in the client's business, what's going on in the world. What are the pressures? What are the good bits of the business? What are the bad bits? All that type of stuff. Then what we do is we put together a detailed plan in writing. And this is a recommendation of a proposed course of action. That plan, as a general rule, recommends the best course of action, but it doesn't run through all the options.
Darren, it's really interesting, isn't it? By providing the recommendation, sometimes people, including our referrers, feel as if we haven't considered all options because we haven't shown all the analysis that we've done. But the truth is that our strategists actually determine the best course of action by looking at all the positive, negatives of all the different scenarios before we make our recommendation.
That's right. Look, there's a lot of factors that go into play when we determine the best course of action. Yeah.
So, Darren, why don't we start there? What are some of the things that our team look at, and particularly with 11 years experience, what are the things that you look at and some of the factors?
Yeah, well, to do that, Ashley, look, you really need to start with making it clear where we fit in the whole scheme of things. As most people listening would know, we're not insolvency practitioners. Insolvency practitioners, or IPs as we call them, represent creditors. Our focus is on representing the directors and the company. It's a really important distinction because it means that our decision making is directed at the director and the company. This can lead to vastly different outcomes in the end.
And mate, that is actually a really good point, because and that can sometimes get lost. So knowing that we're looking at it from the directors and the company's point of view, what are the things that you do focus on when you're looking at this?
Yeah, look, firstly, it's about understanding what the director's overall goal is. Do they want to continue in the business, or have they had enough? They want to go home. Should they continue in the business? And there's some people who think that they have no choice but to continue on trading. They just don't see an option. Often we will work with the accountant before we develop a strategy, so we can look at and collaborate with the accountant if a new business structure is viable, and what are the hurdles, and can the business be rescued? Are there limiting factors such as licensing if you want to stay in that industry?
That one's an interesting one, and on its own, isn't it? We could talk about the obvious one being builders, but even that's really variable between states. There are various impacts on mortgage brokers, on doctors, on many professions, which can have an impact on the strategy that you employ for a client.
Look, I think sometimes, Ashley, we still get caught in some of the old rules when it comes to this stuff. I could talk all day about QBCs here in Queensland and how hard it is to work within their requirements. I call them tyrannical. That's probably a nice word. But given it's a national forum, look, I'm going to step back from QBCC and my rant.
QBCC is certainly one of your hot buttons, but we'll save that topic for another day and maybe do a Queensland-specific one just to deal with that. But after we've had a look at whether the director wants to stay in business, can stay in business, all that sort of thing, what else do we then look into?
Look, from the company's perspective, we focus on things like what's the asset position, what's the encumbered and unencumbered value of that equipment, how does the company generate income, is it contracts, and if so, are they assignable, are there any licenses that need to be transferred, things like liquor licenses, does the company operate from leased premises, and if so, does the landlord, are they supportive of the whole scheme we're going to put in place? If there's secure creditors involved, are there ALPAPs, with what we used to call the old fixed and floating charges? Are there PIMSs, which is the old fixed charges, and they're over such things as cars, trucks, and other pieces of equipment? And what's the creditor composition? I mean, there's a lot to look at.
And look, I probably should say apologise because it's a fairly loaded question, and the list can certainly go on and on. But some of these things that can impact on a rescue to take, others really have no impact. So it's a matter of understanding what, these different factors come into play and what they can really do. So you've said that we're looking at it from a corporate perspective, but there's a lot more to doing an analysis than just looking at the corporate stuff, isn't there?
Yeah, there sure is. Look, one of our main concerns is the personal impact on the director. In some ways, this is probably our most important question. Look, and this involves looking at things such as like how many creditors have personal guarantees, what's the personal exposure in the company, like financiers with credit agreements. Are they secured by property? Are there charging clauses in those contracts? Are there directors' loans to and from the company? And what is the overall wealth of the client? Like, what's their personal wealth position? Are they exposed? And do they have cash reserves, property? Look, we can't get the impact also of the ATO under their directors' penalty regime.
Darren, I'm going to stop you there. As you know, I've just been talking about doing our second series of our seminar, and we still get a lot of people questioning about the priority of the ATO. So when you sort of say that we can't forget about it, can I get you just to talk about where they fit in the priority chain?
Yeah, look. Still, a lot of people don't realise that the ATO is not a priority creditor. Interestingly, about 25 years ago, they lost their priority position. People don't know that it's changed. So I talk to a lot of people who think that the debt's personal. Look, at a corporate level, the ATO is an unsecured creditor, and they've got no more priority than anyone else. Actually, in fact, if you look at it under the PPSR regime, the ATO probably has a lower priority than most other creditors. At least trade creditors can put a level of security through their PIMSs and all PAPs, but the ATO can't. The other thing I hear from directors is they believe that the company's tax debt is automatically their personal tax debt that's owed. This isn't the case.
No. I know we talk about it all the time, and probably some of the people here listening are going to be really annoyed with me saying it again. But can I just get you to run through the director penalty regime, because there is still so many confusions around it that really is just quite frustrating.
Look, it's probably the question I get from accountants more than anything else, and I still get the phone calls every day going, I'm not quite sure how this works. So look, basically there's two types of DPNs, lockdown and non-lockdown. DPNs cover GST, PAYG, superannuation, WET, wine equalisation tax, and luxury car tax. So I don't see the last two very often. And if BAS is lodged on time, the ATO issues what they call a non-lockdown director's penalty notice. This involves the personal liability on the expiry of the notice. And the director is able to achieve remission of that debt if they do one of two things, which is pay the debt or place the company into administration, liquidation, or appoint a small business practitioner. There used to be a third, which was go into a payment plan, but that's no longer the case. So the requirement for lodgements, the timeframe that needs to be adhered to is superannuation SGC has to be paid on the day that it's due. And with GST, PAYG, BAS, it's 3 months from the due date. So if you've lodged outside of those timeframes, you'll get a DPN, which is called a lockdown. Now, the ATO still needs to issue that DPN, but you can't remit the debt personally, and it basically becomes a debt of the company and the directors personally.
And I think that's it's a really big factor when you're looking at any of these scenarios, is what's already caught and what's not. Doing that integrated analysis, doing the analysis of the integrated client account, I know is a big part of what we need to do at the start of any process. But look, we've sort of got a bit off track, Darren, which I have a habit of doing in these things. But it's always important that we sort of reinforce the impact of these director penalty notices, because I think they're a big tool that the ATO is really focused on using at the moment.
Absolutely.
So I said that we were going to talk through some of the options and the pluses and the minuses of the various different corporate strategies that exist. So if we assume that we're staying at the company end, what options and the business is viable and we do want to actually rescue it, what are the insolvency options that are available to directors?
I'll boil it down, make it simple. Effectively, there's three options that are available. There are a number of variations on those options, but look, I'll keep to the basics because otherwise we'll be talking forever. We've got a small business restructure, what people call an SBR. We've got a voluntary administration and DOCA being a deed of company arrangement. And we have a business restructure, or what's commonly known as a pre-pack.
Right. So, Darren, why don't we start with the SBR? They seem to be the flavour of the month at the moment. So can I actually start with why you think they are the flavour of the month?
Yeah, well, it's the shiny new toy. Basically, the legislation came out in 2021, and the legislation was brought out during COVID because the government understood that there was going to be a real duress in the commercial market, and they wanted some products out there that would assist practitioners in helping businesses. There's some good features of that legislation, but look, these are still being spoken about, and they're still evolving.
Yeah, I agree that there's some pretty, I think it's actually some pretty cool things that they brought in with the new legislation, but it's probably still a little bit misunderstood. So why don't we talk about what some of those cool things are?
All right. Well, before we jump into the features, we should start with the fact that there's eligibility requirements for the SBR that the company and the director need to meet before they can use that product. First off, it must be a company. You can't have another type of structure, associations, sole trader. It has to be a company. You have to declare that the company is insolvent or will become solvent. And that's important when we get later on down the track about why that's the case. Tax lodgements we need to be up to date, and employee entitlements need to be up to date. They can't have used the same product within the last 7 years. And the big one, though, is a cap on the amount of debts. It can't be more than $1 million. And that can be quite limiting because those debts include all loans, bank finance, car finance, all creditors, secured or not, can't be more than $1 million.
Right, and it's really interesting. I mean, that is very limiting, but at least they don't include contingent liabilities, which is that would blow out pretty much every business when you can consider some of the contingents. So, the government certainly was looking at this being for the small business, hence, I guess, why they've called it the small business restructure. So what makes this process different?
Look, the big one for me, it's a debtor in possession model. It's the first time I've had this in Australia. It mirrors similarly Chapter 11, 12 in the US. So effectively what that means is the director remains in control of the business on the day-to-day operations during the process. They continue to run the business as per usual, and they make day-to-day decisions. That's not been the case before.
So if the director remains in control, what is it that the SBR is actually doing in this process?
Yeah, well, at a high level, what they do is, firstly, they make sure the company's eligible, and then they ensure information is supplied. There's a lot of information that's required to go through the process. And then what they do is determine if the company can afford the intended offer to creditors. So effectively, the company puts forward an offer to creditors and says, that's what I'd like to do. The IP determines, is it actually achievable? What they don't do is probably just as important, though, Ashley, and that's they don't determine what the plan the company should adopt. It's purely up to the director to make that decision. They're not required to access the return and liquidation, so they don't do a calculation saying if I have to make all these claims and do everything else, what the comparison would be. And they don't make a recommendation to creditors. So what they should accept or reject. They basically say that's the plan, that's what's being put forward.
Right. So that is very different to what we're used to. Yeah, especially here in Australia. I think some of the other jurisdictions, some of that's already come into play. So on your point about assessing in liquidation, though, I've heard that they're still doing that in some cases.
Yeah, like everything, change can be difficult. Even though it's not required, what we do know is that the HO is still requesting the insolvency practitioner does a comparison of what the return would be in a liquidation, and that's for their own purposes. That sometimes can or can't be really done accurately, but they are requiring it. This is probably because they're probably one of the biggest creditors to the company. And I suppose the IP feels like they need to cater for a significant creditor.
I could say so much about that, about using undue influence and undue power because of who they are and what they are. But for the sake of not being controversial on a recorded webinar, we'll let that one slide through to the keeper. But I guess it is a valid point, though, that although the legislation says they don't have to, it's not always knowing just what the law says, but it's understanding what's actually practically happening on a day-to-day basis. So if you're going to pick one of these things to do to protect yourself, you've got to know how it's going to flow, whether it's by the rules or working around the edges of the rules based on someone using old knowledge. So the fact that the SBR has a limited role probably leads us a little bit into the next point around the cost of the SBR.
Yep. Well, one of the main reasons an SBR was brought in was to allow small business to have an opportunity to complete a debt restructure without a really high cost. When you look at that, you look at a voluntary administration, the first thing people say, it's expensive. So what do they do to implement it? What they did was implement a fixed fee for the whole process. And what happens is that fee is agreed to at the beginning. And once the fee is set at the start of the process, there can't be any additional costs. So you know what you're getting.
Right.
From that, what we've seen is an upfront fee, usually around about the $15,000 mark, but it is variable. Look, and if the offer is accepted, the insolvency practitioner also takes a percentage of the return that's the return to creditors through the payment plan or the compromise as the administration fee.
Right. So that's certainly a massive change for any other form of insolvency that we deal with here in Australia, where there really aren't any cost limits at all. So, once you're appointed, it can turn pretty messy with the costs, but we don't have that now in this one, which is pretty handy.
Which is great.
So let's now talk about the voting process, because this is another area where they've tried to help keeping the costs down.
Yep. Look, I guess there's two things to think about the voting process. Firstly, in an SBR, there's no creditors meeting. Most of everything is done electronically. The reports and the voting forms are all emailed, and the creditors need to respond to that email, so you don't have to turn up. It's even gone so far as they're proposing to actually vote online, so from end to end. And that process for the insolvency practitioner cuts a lot of costs down.
Yeah.
The second thing is the vote. The vote itself is based on a simple majority of those who vote, and it's on a dollar basis. So 50% in dollar vote yes, then the proposal gets up. It should be noted, even if a creditor votes no or didn't vote, they're still bound by the outcome of the vote.
Yeah, and look, that's fairly common across the couple of forms of, but it is true. It's you can't just ignore it and think that you can go. I had someone ring me up the other day going, "We're not going to accept the results of the vote." And I went, "Well, sorry, mate, but that's the law." Anyway, that is certainly much simpler than what we normally have to deal with the voting regimes in the other forms. What are some of the other things that you want to highlight about the SBR?
All right, so there's a couple other things to note. One is an SBRP doesn't have any power to pursue enforcement against the director or other creditors. So it's simply an assessment of the ability to make those payments. That means there's no things like insolvent trading claims, no preference action, no uncommercial transactions. So if you've got a director that's got significant personal asset position, that can be a really valuable asset or valuable in the assessment of what you're trying to achieve.
Yep.
Look, as usual, you get a stay in proceedings, any legal proceedings. So while it's under the SBR process, you can't take new legal proceedings or pursue existing proceedings. Yeah. Probably the final one is what happens if it fails. It's really important. So if creditors vote the proposal down, it's a really interesting one because the company just remains in place in the hands of the director, and it doesn't continue to trade. It continues to trade effectively, and the SBR goes away. It's not fatal to the business. Now, in a voluntary administration, if you fail the vote, the company goes into liquidation, and that's substantially different. So as you can imagine, though, look, if the vote doesn't get up, the company's still in financial trouble, and the creditors still have voted down, so they'll probably take their enforcement action to continue to have the company wound up.
Yeah, so, and I think that's just for clarity, because I think there might have been a glitch at the time, is that the director continues to run the business. If it fails, it just goes on.
Yeah.
And that's certainly not what we're used to in the Australian marketplace. But but that would mean that if a director decided to take the path of an SBR and it failed, they'd then have to think about doing another form of insolvency on top of what they've already done. Because, as you said, the creditors aren't going to go away, and they didn't do it in the first place for no reason, did they?
That's exactly right. It hasn't got rid of your problem. It's just it hasn't not catastrophic for the company immediately.
If anything, it's probably inflamed a few creditors, particularly if they're saying no.
Yeah, probably.
So, okay, so that's interesting. So you paint a pretty good picture for an SBR that it's a pretty cool way of going. But like everything, you know, if a business does qualify, what do you see as some of the risks and disadvantages of the SBR?
Okay, look, so there's a few things to that I need to highlight, I suppose, on that side. Is the first thing, and I know it's I said it's a simple vote, that related parties can't vote in an SBR, where they can in a voluntary administration. And look, and in small business, the directors probably have put more money into the company than anyone else, but they don't get a say. Under the SBR, they don't have the same rights as other creditors, effectively. In fact, they probably have got no rights at all, and they're still obligated to be bound by whatever the deed says.
Right.
And then, as I said, often the director is probably the biggest creditor aside from the ATO.
And Darren, that really is quite a big change, and something that, you know, I know over the years and jobs that you and I have worked on, looking at the loan structures of the related parties could make a really big difference to how you want to play something, knowing that you're going into something with some control, with some knowledge that you've got some impact in how it's all going to play out. But without that influence, it can make things very tricky, I'd imagine, when we're looking at it.
You need to be very strategic.
Good word for it, yes. Okay, so what else have you got, mate, that we should be keeping an eye on with these SBRs?
Look, although I think the debtor in possession model is really beneficial, one of the big issues is creditor support. And I don't mean from a voting point of view. I mean, since the director continues to run the business, they need to ensure that creditors will continue to support the business, such as trade creditors and financiers, because they're going to be involved, they're going to get notified. Look, if they're on credit terms, primary suppliers might get a bit nervous. You know, they might want to go COD. That might be a bit strain on cash flow. As I said before, you can't enforce, but that doesn't mean they don't stop supplying either. What we're seeing is many suppliers are going cash COD straight up. You know, and you need to take that into consideration. And it can have a really dramatic effect on the business when that happens.
Absolutely. And look, you know, you think about it, you've got a business that's already in financial trouble, and then they're told they have to go cash in advance on everything. That's going to make life really difficult for a business to try and trade through to get to the other side. So I know that that's a really high-level run-through of the SBR, but I really appreciate you trying to break it down into some pretty simple terms for us. And there's certainly some really good points when you consider which way to go. And for me, I think the SBR is so popular at the moment in terms of people talking about it, but there are a lot more risks to it than a lot of people are giving it credit for at the moment. So great tool, love it, but be careful. So, mate, let's switch now to the voluntary administration, something that you and I have been doing for many, many years. And so I guess the SBR is really a smaller version of what the voluntary administration and deed of company arrangement process really was and what it really is. But can I get you to highlight, probably the easiest way is, what are some of the differences between the two models, since we've spent a bit of time on the SBR?
Yeah, sure. Look, the first thing is there's no qualifications for voluntary administration. Any business with any debt level can use the process. And it can be for contingent liabilities, anything effectively. Basically, they both have the same goal in the end, which is allow for a compromise of the debts for the continuation of the business. You get the same protection from creditors during the same process, and after that's where we start having a lot of variation.
Right. So why don't we talk about the variation? Why don't we talk about cost to start with, given that the SBR was brought in to try and counteract this cost issue?
So look, the big difference is the VA doesn't have a cap fee. And as a general rule, they charge on a time cost basis. And as you know, with insolvency practitioners, this can rack up really quickly. And one of the reasons they rack up is another point of difference. The VA is not a debtor in possession model. The VA assumes control of the business and is responsible for running the business basically day to day. So just think like a VA, in effect, pulls up his car, comes up to your business, sits in your seat, and he runs it.
Yep.
And as you can imagine, that VA, what he charges to run that business through that process can make it really expensive.
Yeah.
Another difference is the administrator is responsible for the business. So everything he pays, every supply that he pays, he's responsible for that. And even though they sometimes can provide a much higher level of comfort for your creditors, people like suppliers and financiers, it is a risk that they take and they have to be prepared to take on. So unlike the SBR process, it doesn't have that effective guarantee for their work as they go through the process.
And that in itself, you spoke before about the creditors might want to go cash in advance. The VA obviously can give them the guarantee that they're going to get paid, but that makes the VA really nervous because they actually have to give a guarantee on a whole bunch of credit of a business that they know nothing about.
Well, from a technical point of view, look, they're going to want specific cash flows and accurate cash flows. A lot of work financially needs to be done to convince a voluntary administrator to take that risk.
It's certainly something that that's what causes a big part of the problem, isn't it? So rather than being worried about how they're going to get paid, they're now the creditors get that comfort and know how they're going to pay and how they're going to get paid, which is a good thing. But now you've got an administrator that may not want to run that cost and move forward. So what else, mate, are some of the big differences?
Look, one of the big things you have to have a look at is the voting process. So firstly, related parties can't vote in a voluntary administration and DOCA. That's a big one for us. As I said, sometimes it gives us comfort and control. And as I said earlier, directors normally have significant loans to the business, and that gives them a lot of power in the voting process. The second is the voting process itself is a bit more complicated. So there's a meeting of creditors, and then there's a vote on the voices. Look, that's a simple majority of who turn up to the vote, and the result of that vote dictates if the vote's successful or not. Now, if a creditor is unhappy with that result, they can ask for a poll. And what a poll is a second vote that's based on the dollars. So you might have a significant creditor like the ATO, you've got 9 people say yes, and the ATO says no. And the ATO says, well, I want to do a poll, and then it based on the dollars of yes, dollars of no. Now, in the case where that is a win for the no vote, what you basically got is a draw. One vote of the voices, one vote of the dollar. And then what happens is the administrator has to turn down a casting vote.
Right. So, and look, that's an interesting one on its own. So how is it that the administrator decides how they're going to vote?
Well, this leads me to the other major difference in the SBR and the VA, which is the administrator on a voluntary administration has to write a very detailed report to creditors at the very beginning. And the purpose of the report is to provide a detailed commentary on the business. It also provides a breakdown of potential claims. They can't act on the claims, but they have to highlight them, and they have to look at things like unfair preferences, uncommercial transactions, even potential insolvent trading. And their job is to highlight what claims would be available in liquidation and the chances of recovery if pursued. Then they do a comparison on the offer and then they look at and say, well, make a recommendation on what they think creditors should accept. And that decision on that report is generally how the administrator will vote if he's required to put a casting vote in the vote in the meeting.
Right. So I could only imagine that in that report, making claims of insolvent trading or the potential that there's undue preferences could have a real impact on the ability of getting someone to say yes or no to a report. Whether they can actually collect on that's another thing, but there's certainly some of the wording in those reports can make a director look pretty bad, which then means creditors may not want to support anywhere near as much.
Yeah.
So, Darren, the SBR and the VA you mentioned before are a debt restructuring process. I'll get you to move on now because we are going to run out of time otherwise to talk about the business restructuring process within the insolvency framework.
Okay, so what we're talking about is what people commonly refer to as a pre-pack. Look, in simple terms, it's a pre-planned sale of the business before placing the company into liquidation.
Right. So, Darren, I'm going to jump in before someone puts it in the chat box. But isn't that a phoenix?
Yep. Look, that's what the ATO calls it. But there's a big difference, as most people consider a phoenix to be illegal. A phoenix doesn't have to be illegal. The concept of a phoenix is that it's a transfer of assets that's occurred to avoid creditors or defeat creditors. It can be done legally. What you need to do is obtain valuations of the business. What's it worth? Goodwill valuation, plant equipment valuation. Then you enter in the sale of that for full value. It's going to be full market value. And then, of course, the value's got to be paid to the company. Right. That way is what they've called legal phoenixing.
I know the way my tongue works, illegal and legal actually they're very close together, isn't it? So
it doesn't really make a lot of sense, but they just like calling it the same thing.
Yeah. So for the sake of today, we'll continue calling it a pre-pack. And I know that we've spoken a lot about the contention of this issue on a number of the webinars before, but I think that really, I always find the simplest way to say it is that if you've got let's say the assets are worth 100 grand in the company, and then a business restructure is done and we sell it across to the new entity, all we're doing is converting physical and IP assets into cash that's going to be sitting in the bank of the old company. So no creditor is being undermined by the process. We're actually just changing the structure of what the asset looks like. I'm going to leave it there for today because otherwise we could spend the rest of today just purely talking about the Phoenix issue, which is frustrating in some ways. So why would it be that you would consider a business restructure compared to looking at debt restructures?
I think the first one that comes to mind is cost. As a general rule, the cost to the business is often much lower than the other two options. Because a pre-pack's planned before the insolvency event, it generally is less invasive during the process. It's not known to the public until the transaction's completed. And the business doesn't have to take everything. Effectively, they can cherry pick actually what it wants from the old business. Now, a business structure can be used to right-size the business. And I know you've discussed that before, but they can take the good bits out of a business and the things that don't work, they don't need to take that across.
Yeah, I think it was in one of our webinars with Sophie Pantis, if anyone wants to look it up. We ran through some fairly detailed case studies of right-sizing a business.
Yeah.
So anyway, I'll let you keep going. So on the downside of using pre-packs?
Yeah, look, one of the big potential downsides, is the potential personal impact on the director. As I mentioned, look, both the SBR and the VA, they don't have the right to pursue various claims, but in the pre-pack process, where there's a liquidation at the end of the process, the liquidator can make all those claims, pursue all those claims. So look, if a director's got significant personal assets, you need to be mindful of that position. It doesn't mean that you can't be done, just it needs to be assessed properly.
And I think that's the key, isn't it, mate? Is that every unique scenario is unique in its own right, and making sure that you look at both the corporate and the personal and bring those two together to come up with the best plan. But Look, we're at an hour for 40 minutes now. So I know that listening to me for 40 minutes is a long bloody time. They're never alone having the two of us on. So why don't we, before we open up and go to the floor for questions, if anyone wants to type any questions in, I'll just hand over to you for your final bits and final say.
All right, look, I suppose through this whole process, I'm a great advocate of working backwards when I devise a strategy. The first thing I normally look at is the director's personal objectives and their asset position. Because I'm really mindful that directors, there's actually a family that needs to have some certainty behind that. And they need to know what the future looks like. Do they want to retain the home? Where do the kids go to school? Are the vehicles used day to day at risk? Does the wife's car need to be protected? How will they generate income? Things of that nature. And from there, I work out how do I protect that realistically, and I work backwards. And I find that always gives a better result than dealing just with the corporate.
Thank you, mate. I really appreciate it. I know, like all of the other strategists, they'd love to spend time talking about it, but when I ask them to do it on the webinar, you're all not a big fan of it.
Run for the hills.
You'd rather be there outside the boardroom talking to a client than talking to me about it all. So thank you very much for your time. I will open up now if anyone does have any questions for Darren or myself about it. Look, I will say really high level what we've done today. I think each of the three different scenarios we could spend hours on in their own rights, and in different webinars we have done that. So trying to just bring it all together at a high level. But the one thing I do want to finish with before we and while you're doing the poll, because the poll's just popped up in the middle of the screen there, is please be really mindful that you need to have this holistic approach. There are a lot of people out there at the moment saying, here, come and we can do an SPR for you. You'll do a VA because that will mean that you have no financial problems personally. But bringing all of the pieces together corporately and personally, like if a director has to go personally bankrupt because of all of the personal guarantees, doing a VA and spending the extra money on a VA is a complete waste of time. So there's a whole lot of things that a lot of people don't get and don't understand. And what we pride ourselves on at Jonge Read is that we provide that independent, holistic approach, and that report is provided free of charge to everyone. So please be mindful of that. Lean on all of our strategists. Hank and I are a big fan of everyone getting on the phone, talking to our entire team about anything that you've got that's in front of you. And we can talk through some of those scenarios before it even goes to paper if need be, or even before we talk to a client. So that's pretty much all of it for me. A very old joke from Sam at the start, Darren, that I didn't see pop up was Sam said probably when we were talking about the QBCC, probably a charitable description for the QBCC.
Yeah.
So, we're being very polite. They always say you've got to be mindful of what's put in recording. So if there are no other questions, we'll look to wrap up there. If you do have a question and you're like me and you can't type fast, just hit the little the thumbs up button and I'll hold on. Otherwise, thank you all for attending again. It's always great to have you along. Darren, thanks again.
Thanks for having me.
You're free for a while now, mate. You'll before you get back into the roster and rotation again. So, yeah. Thank you all. Have a great day, and we'll see you in a month's time.
Thank you.
Thank you.